Good morning. My name is Ezra representing Bond Investments. Today I'm presenting our acquisition and development strategy for 41 to 45 Ireland Street, Freeman's Bay. Our objective is to fulfill Jackson's specific directive, capture a high return development opportunity but completely avoid operational mess. We've engineered a clean, high performance strategy that maximizes capital velocity without locking the firm into ongoing multi-sector management headaches. Let's look at the site fundamentals. This site is a 636 square metre freehold corner parcel. It currently holds a 684 square metre office and warehouse building yielding 184,000 per annum net. We have two major immediate advantages here. First, the flat contour simplifies all future earthworks. Second, the lease features a 12-month redevelopment demolition clause. This gives us an unencumbered, predictable timeline to clear the site and break ground when we choose. The location is a prime city fringe real estate. We sit directly adjacent to the New World Freeman's Bay supermarket and just 350 metres from Victoria Park. With immediate CBD proximity and seamless transport links, this pocket of Freeman's Bay is highly insulated from market downside and acceptably attractive to affluent end users. This precinct offers a powerful dual market advantage. Regionally, commercial prime vacancy is low at 10.8% and dropping. Demographically, the residential metrics are even stronger. 65% of local residents are white-collar professionals, and the median personal income is $21,400 higher than the New Zealand average. The catchment has the clear financial capacity to support premium high-spec residential product. The macroeconomic timing is highly strategic. The Auckland market is on an upward trend, with sales activity rising 60.8% month on month. Crucially, interest rates have eased to a 3.5-year low of roughly 6.16%. As borrowing costs decline over our planning phase, buyer confidence will peak right at our finished units as our finished units hit the market. On the global stage, easing supply chain volatility is lowering raw material risk. As institutional capital flows migrate toward value-add strategies, well-located city fringe real estate is gaining major momentum. Our project sits directly at the intersection of these positive cycles. To determine the absolute highest and best use, we initially stress tested 6 development pathways. We analysed everything from standalone commercial builds to subdivision models, weighing each against construction costs, regulatory speed, and long-term execution complexity. We systematically cut the list down to 3 variable options. We eliminated mixed-use redevelopment while high-yielding management split-focused retail leases alongside residential body corporate creates an ongoing operational mess that violates our mandate. This left us with 3 clean single-sector pathways: apartments, refurbishment, and an air rights sale. Our shortlisted options provide 3 distinct risk profiles. Option 1, a 4-story high-spec residential building comprising 35 units. Option 2, a pure value-add refurbishment of the existing commercial footprint. Option 3, an air rights sale, retaining the commercial ground floor while selling the upper residential rights. Now for our financial outlook. Option 1. Let's look at the financial performance modelled against our 12% discount rate hurdle. Option 1 is a pure build and sell trading model. The metrics are outstanding. It delivers a 15% IRR, a powerful positive NPV of $1.5 million, and an absolute profit margin of $10.7 million. The cash flow curve shows standing vertical development drawdowns, fully recovered by sales in year 4 and 5. Option 2, the refurbishment, fails our hurdle rate. Because the heavy structural upgrades trigger 95% vacancy period, cash flow is severely disrupted early on. This results in a weak 10% IRR and a negative NPV of minus $972,000. Capital is tied up for a decade to actively lose value against our discount rate, so this option is discarded. Option 3, the air rights sale, is financially viable, hitting exactly our 12% IRR hurdle. Because the vertical rights are sold up front, peak equity drops to just $3.44 million and with 0 construction exposure. However, the absolute profit margin is incredibly thin at $1.18 million. It leaves too much money on the table for the third-party buyer and surrenders site control. Stacking the data side to side reveals a stark contrast. Option 1 is our clean financial alpha, leading comprehensively on both total value basis with its positive 1.47 million NPV and a rate of return basis at 15% IRR. The alternatives simply do not match the level of capital efficiency. Our master financial ledger confirms the underlying mechanics. Option 1 draws a total revenue of 37 million against cost of 26 million, generating a robust 41% margin on cost, while option 2 looks large, nominally over 10 years, its time-adjusted value fails. Option 1 mathematically extracts the maximum performance for our initial capital employment. Based on the data, our definitive recommendation is to proceed with option 1. Its massive 10.7 million profit margin serves as a vital shock absorber against cost overruns or market shifts. Option 3 remains a secure corporate fallback if risk appetites change, while option 2 is officially removed. Overall, option 1, residential apartments for sale. The core advantage here is the clean exit. We build, sell, and achieve full capital recovery within 5 years, with zero ongoing management or tenancy obligations. The primary challenge is the 25 million peak equity requirement. However, given Freeman Bay's exceptional demographic tailwinds, this is a highly calculated risk backed by a massive margin buffer. Option 2 is refurbishment. To confirm why we are declining the refurbishment, although it offers low construction risk, the financial trade-off is unacceptable. A 10-year capital lockup combined with a subpar 10% IRR means we are failing to meet the basic investment criteria of the firm. Option 3. Similarly, for the air right sale, the benefit of zero vertical construction risk is offset by severe constraints. We accept a minimal absolute profit of 1.18 million, lose control over what is built above us, and become entirely dependent on a third-party developer's performance. To summarise, option 1 is the single best strategic fit. Financially, it stands alone with a 15% IRR and a 10.7 million margin. Strategically, it captures the highest and best use of the zoning. Operationally, it perfectly honours the no-mess mandate, a clean, singular focus, full capital velocity within 5 years, and no lingering tenancy compliance. It is a highly disciplined build and sell play. Our execution timeline is highly structured. Month 0 to 6, complete the acquisition and legal frameworks. Year 1 to 2, secure resource and building consents while running off pre-planned sales. Year 2 to 3, appoint our Tier 1 contractor and execute the construction program. Years 4 to 5, complete construction and settle all unit titles, returning clean capital to the firm. Thank you for your time.